Hey there everyone, how's it going? Welcome back to the channel. If you're new here, I'm Tom, and today we're diving into why the economic cycle is stronger than the Fed, and why this is something every crypto investor needs to understand right now. The Fed has been trying to steer the economy with interest rate cuts, but the truth is, they can't control the entire cycle. Or can they? Well, that's exactly what we're going to unpack today, how these moves by the Fed could impact the markets, and more importantly, your crypto investments. So let's get into it. There's a lot of talk right now about the Federal Reserve and its plans to cut interest rates, possibly by 25 basis points in September and even more by the end of the year. But here's the thing. While the Fed has some influence, the broader economic cycle has a life of its own. The Fed can try to manage it, but they can't stop it. As we look at the current signs, it seems like the US might be heading into a recession, regardless of what the Fed does. And that's where things get interesting, especially when we consider how these shifts can stress test assets like Bitcoin. This brings us to a crucial question. How will this affect the upcoming US elections, especially since one candidate is more crypto-friendly than the other? Now, here's the thing. When the economy is on shaky ground, it tends to shake up the political landscape too. If we slip into a recession, it could actually give Trump an edge. Why? Well, when the economy tanks, people usually point fingers at the party in power. Right now, that's the Democrats with Kamala Harris as their candidate. So the stakes are sky high for her if the economy continues to head south. However, the Fed has made it clear that their decisions aren't influenced by politics. They're focused on price stability and employment, not on who wins in November. Now let's talk about what's been happening recently. We saw the markets take a significant hit. Even though Bitcoin took a hit and didn't collapse, it's still highly volatile, as you might know. Traditional markets like the Nasdaq and the S&P 500 and various tech stocks in particular have seen sharp corrections after hitting historic highs. This was triggered at some degree by some alarming economic data. The US unemployment rate jumped from an expected 4.1% to 4.3%, and job creation numbers fell well below expectations, with only 114,000 jobs added instead of the expected 175,000 in July, which set off alarm bells across the market. Let me explain why this is so important. There's a recession indicator called the SOM rule, named after economist Claudia Sahm. The SOM rule signals the early stages of a recession when the 3-month moving average of the unemployment rate is half a percentage point or more above the lowest rate over the past year. As of August 4th, this indicator has crossed that critical threshold, suggesting that a recession might already be starting. Now, let's shift our focus to the international stage. The recent market stress isn't just about poor economic data, it's also being exacerbated by the unwinding of the yen carry trade. We've been talking about the widowmaker trade, or carry trade, for at least 3 years in the CryptoVagabonds Academy, and now we're seeing it play out. The yen, which had been depreciating significantly to levels unseen in 40 years, suddenly started to appreciate rapidly after the Bank of Japan announced a rate hike from 0.1% to 0.25%. This move signals their intention to gradually increase rates further, with a long-term target of 2%. They may not reach the full 2% this year, even though they're still far from that goal. This modest increase has already led to a significant appreciation of the yen, which has sent ripples through global markets, including the US stock market. We've seen the Nikkei, Japan's leading stock index, take a dramatic hit, losing nearly 10% in just 2 days. So, for those who aren't familiar, carry trade is a strategy where investors borrow money in a country with low interest rates, like Japan, and invest it in countries with higher rates to profit from the difference. For example, if you borrow $1,000 at an interest rate of 0.10%, as it was in Japan, the cost would be just $1 per year. On the other hand, if you lend $1,000 at an interest rate of 5.50%, as it currently is in the US, the return would be $55 per year. This strategy works well until it doesn't, when the low interest currency, like the yen, starts to appreciate, forcing investors to unwind their positions, which leads to market turmoil, the so-called short squeeze. And this is precisely what we've been witnessing recently, and it's why the yen's movements are something to keep a close eye on. Adding to this, we have geopolitical tensions escalating, particularly in the Middle East. Israel has reportedly carried out assassinations of key leaders in Iran and Lebanon, further fueling instability in the region. These geopolitical issues are unpredictable and add another layer of risk to global markets. The combination of economic and geopolitical stress is making the markets highly sensitive right now. Let's bring it back to the US and the Treasury yield curve, specifically the 2-year, 10-year, and 30-year bonds. Those of you who've been following the channel know that Boof has been saying we're not out of the woods yet. The inversion of the yield curve, where short-term rates are higher than long-term rates, has historically been a reliable predictor of upcoming recessions. Now, the curve has started to steepen again, signaling that a recession might be closer than we think. So, do I think the Fed will cut rates again in 2024? There's a strong possibility. But let's be real. Rate cuts often come too late. By the time they happen, the recession is usually already in progress. If the Fed does cut rates drastically this year, it could be a sign that things are worse than they seem, but if they don't, it might only delay the inevitable. So, what does all this mean for your crypto investments? The reality is that every market, including crypto, will be affected by these economic developments. Bitcoin and other cryptocurrencies remain highly volatile, and the traditional markets are already showing signs of stress. While Bitcoin isn't a hedge against inflation in the short term, it's still crucial to keep an eye on how these macroeconomic factors are playing out. As the economy potentially heads into a recession, the stress on traditional markets could lead to increased volatility in crypto as well. It's vital to stay informed and ready to navigate these choppy waters. If this is making you rethink your crypto strategy, or maybe just making things clearer, go ahead and smash that like button. And if you're enjoying this deep dive into how the world outside of crypto impacts your coins, don't forget to subscribe. We've got plenty more insights coming that you won't want to miss. Let's keep going. That's it for today, folks. Thanks for hanging out with me. Keep questioning, keep learning. I'll catch you in the next video. Stay curious and stay hodling.